Today I would like to analyze Starbucks, one of the largest coffee chain company in the world. The expected earnings per share were around 49 cents and they had a disappointment with 41 cents reported. The revenue was also lower than expected. The stock price is 19% down in the last month, so we're gonna take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 90.96 billion US dollar. This makes Starbucks the sixth largest beverage company in the world by the market cap. We also have a dividend yield of around 2.88%, which we can see here did grow in a very good rate in the last 10 years. We're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. In 2020, the revenue was around 23.5 billion US dollar. This was an 11% decrease from 2019, so probably related to COVID. Then in 2021, we had the comeback with a growth around 23%. This is something we like to see. In 2022, we had the increase around 11% in the revenue. This is also a good growth. In 2023, around 11.5% growth. This is also very good. And then in 2024, we just had the growth around 0.56%. So this is not very high, but overall in the last 5 years, we had a good growth. So as a check here. The next thing we're looking for is free cash flow growth in the last 5 years, a very important number because the free cash flow can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So the free cash flow was around 0.11 billion US dollar in 2020. This was a strong increase around 96% from 2019. So again, this was related to COVID. Then we had the strong comebacks with around 4.52 billion US dollar in 2021. Then in 2022, we saw the decrease again around 43%. And then in 2023, we saw the comeback again with 43% increase. Then in 2024, we saw the decline again around 9.71%. So the free cash flow was very inconsistent and it's not a check here about the free cash flow growth in the last 5 years. If we take a look at the operating cash flow, we can see it decreased in 2020 and also in 2022. But compared to the free cash flow, it didn't increase in 2024. So the reason for that is that we had higher capital expenditures. So we can see here in 2024, the capital expenditures were quite high with 2.78 billion US dollar. This means the company investing more money into the business, but the operating cash flow increased around 1.45%. So it's not a bad thing. But we also can see the growth is slowing down in this company. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to calculate the free cash flow yield. We're going to take the free cash flow from 2024, 3.32 billion US dollar. We're going to divide it with the current market cap, 90.96 billion. So then we're going to get the free cash flow yield for 2024. So the number we're going to get is around 3.64%. So I think this free cash flow yield is quite low, it's under 4%. So it's not an indication for undervaluation and it's not a check here. So I think we should also make some assumptions about the free cash flow in the future. If we ask ChatGPT, we can see here the free cash flow for 2025, 2026, and also 2027. So these are the assumptions before the earnings miss and also after the earnings miss. So for 2027, the free cash flow assumptions would be around 4.7 billion US dollar before the earnings miss, and after the earnings miss, around 4.2 billion US dollar. So we're going to use that number 4.2 billion US dollar. This is more pessimistic for the next years. Then we're going to divide it with the current market cap. The current market cap, 90.96 billion. So then we would get the free cash flow yield for 2027 with our free cash flow assumptions. So the number we're going to get would be around 4.61%. So I think this looks already better. It would be over 4%, and I think it would be a fair valuation, but only if the free cash flow can increase in the future as well. The next thing we're looking for is the debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So we're going to take a look at the long-term debt first. We can see here 14.34 billion. We're going to add the short-term debt as well. So the short-term debt is around 1.25 billion. Then we're going to divide this with the current free cash flow, 3.32 billion. And then we're going to get the ratio that we're looking for. So the number we're going to get would be around 4.69. So I think this is a decent number. I think it's not a great number. It's under 5, so it's a check here. But I still think this company maybe have a little bit too much debt. We can also take a look at the cash on hand. We can see here around 3.54 billion US dollar. I think this is a decent amount, not very high, but I think overall the balance sheet is looking quite okay. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. So first we're going to calculate the enterprise valuation. So this is the current market cap, 90.96 billion. We're going to add the debt as well. So the debt is around 15.59 billion. We're going to take minus the cash. The cash was around 3.54 billion. So this is what the enterprise valuation is. We're going to add the debt. We're going to take minus the cash. So the enterprise valuation, I will calculate it quickly. This would be around 103.01 billion. So this is how much the whole company is worth. Now we're going to divide it with the current free cash flow. This is around 3.32 billion. So then we're going to get the number around 31. So this number is quite high. It's over 25, and this could be an indication for overvaluation right now. So it's not a check here. We can also calculate this number for 2027 with a free cash flow around 4.2 billion. So then we would get a different number. So the number we would get would be around 24.52. So again, it's under 25, so it would be a fair valuation, I would say. But this company doesn't look undervalued, even if the free cash flow can grow in the future. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that especially we think the company is undervalued. So we're going to take a look and we can see, yes, this company buys back a lot of their shares in the last 10 years. So the question is, are they buying back their share at a good price? So we don't like to see that if we think the company is overvalued. So I think in some years this company was definitely overvalued and they're buying back the shares at an expensive price. And the balance sheet is also not looking so great. So I think it's something we don't really like to see. So it's not a check here for me. I think the shares outstanding decrease, but I think the timing is maybe not the best. I would like to give my conclusion about this company, so let's start with a positive. So I think we had a decent revenue growth in the last 5 years. The balance sheet is also looking quite decent. Maybe the debt is a little bit too high. But what we don't like to see is the free cash flow decline in the last 5 years. The free cash flow was very inconsistent, and also the free cash flow yield around 3.64% is not very high, and this can be an indication for overvaluation. But with our free cash flow assumptions for 2027, it would be around 4.61%, which could be fair valued. But our enterprise valuation to free cash flow ratio around 31 is again quite high. This can be an indication for overvaluation, and also in 2027 with our free cash flow assumptions it would be around 24.52, and I think this still doesn't look undervalued in the future as well. So overall I think this company is not a buy right now. Only if you really believe this company can grow the free cash flow in the future, then this company maybe could be fair valued. If you found this video helpful, don't forget to like and comment and subscribe for more content.